Direction is decided on the highest time frame, not the entry chart, and this single truth separates men who survive from men who constantly start over. The market moves in layers, and every layer answers a different question. The highest time frame answers the only question that truly matters: where is capital committed, and in which direction does it have the right to flow? Everything below that is secondary. Most traders reverse this order. They start with the smallest chart, find something that looks convincing, and then search upward for confirmation. By the time they reach the larger picture, they are already emotionally invested, and emotion poisons judgment. When a man begins from the top, he does the opposite. He commits his mind before he commits his money. He lets structure shape his belief, instead of letting hope shape his trades. The highest time frame strips the market of noise. It shows pressure, imbalance, and intent that cannot be hidden by short-term movement. It does not care about your timing, your indicators, or your opinions. It simply shows who is in control. When you align with that control, you stop fighting forces you cannot defeat. When you ignore it, every small gain feels fragile, and every pullback feels like danger. This is why traders who live on entry charts feel constant anxiety. They are navigating without a map. A clean entry against the dominant structure is still a bad trade, because the market does not reward precision without alignment. Precision only increases efficiency after direction is settled. The higher time frame also teaches restraint. It reminds you that not every market deserves your attention, and not every day deserves your participation. Capital grows not by being active, but by being correctly positioned when conditions are right. When direction is clear from the top, patience stops feeling like discipline and starts feeling logical. You wait because there is nothing to do, not because you are forcing yourself to behave. This removes emotional urgency, which is the root of overtrading. It also simplifies risk. When you know the larger structure, your stop is not a guess and your target is not a wish. Both are anchored in reality. Confidence grows quietly here, not from winning streaks, but from knowing you are standing with the market instead of in front of it. This kind of confidence survives losses because it is built on process, not outcome. Men who master this stop blaming entries, news, or bad luck. They understand that direction forgives imperfect timing, but perfect timing never forgives wrong direction. This is why every durable trading career begins at the top and works its way down. Not because it is exciting, but because it works. Lower time frames exist only to serve higher time frame intent, and when a trader forgets this, confusion becomes his permanent companion. The smaller chart has a dangerous charm because it moves quickly and responds immediately to every thought and emotion. It creates the illusion of control, as if constant observation equals understanding. In reality, the lower time frame has no authority of its own. It does not decide direction, it does not create trend, and it does not move capital. It merely reflects how the market reacts to decisions already made at higher levels. When a man allows the lower time frame to lead his thinking, he hands authority to noise and then wonders why his results are inconsistent. The lower chart is a servant, not a commander. Its only legitimate role is to help execute an idea that was formed elsewhere, in a place where structure is clear and emotion is muted. When intent is defined from above, the lower time frame becomes calm and useful. It shows where participation can be efficient, where risk can be contained, and where patience should still be exercised. Without that intent, every fluctuation looks important, and importance is confused with opportunity. This is how overtrading is born. A trader sees movement and assumes meaning, but movement without context is nothing more than activity. The market is full of activity that leads nowhere. The higher time frame filters this out. It tells you what matters and what does not. Only after that filter is applied should the lower time frame be consulted. Used correctly, the lower chart refines behavior instead of dictating it. It allows a trader to enter with precision while remaining emotionally detached. Used incorrectly, it invites impulsiveness, second-guessing, and constant interference. Many traders sabotage good ideas because the lower time frame frightens them out of positions that were correct from the beginning. They confuse normal reaction with danger and exit not because the idea failed, but because their confidence was never rooted in structure. When the higher time frame intent is respected, lower time frame volatility loses its power to intimidate. Pullbacks are seen as movement, not threat. Consolidation is seen as preparation, not boredom. This perspective stabilizes the mind. It reduces emotional wear and allows discipline to operate without force. Risk management also improves because exits are no longer emotional decisions. They are responses to violations of intent, not to discomfort. A trader who understands this stops micromanaging his trades. He stops reacting to every candle and starts allowing the market to do what it is permitted to do. This patience is not passive. It is informed. It comes from knowing that the trade was never about the lower time frame in the first place. The lower time frame is simply the tool through which the plan is expressed. When that relationship is respected, execution becomes cleaner, confidence becomes steadier, and results become repeatable. Patience is a position, not a weakness, and most traders fail to understand this because they measure effort by activity. They believe that if they are not in a trade, they are falling behind, and this belief quietly drains both capital and clarity. The market does not pay for participation. It pays for correctness, and correctness often requires waiting. Waiting is not empty time. It is time spent protecting capital, protecting focus, and protecting emotional balance. A trader who cannot wait is a trader who will eventually force opportunity where none exists. That is not ambition. That is insecurity dressed up as confidence. When patience is understood as a position, the trader stops feeling guilty for doing nothing. He recognizes that inactivity, when aligned with structure, is a deliberate and intelligent decision. The highest time frames move slowly for a reason. They represent decisions made by large interests that do not rush and do not react to minor fluctuations. When you align with those forces, you must also adopt their pace. Impatience pulls a trader down into noise, where every movement demands attention, and every pause feels like a missed chance. This is how men end up trading out of boredom rather than necessity. Boredom is one of the most expensive emotions in speculation. It pushes traders to abandon process and seek stimulation instead of alignment. Patience neutralizes boredom by reframing time. Time becomes an ally instead of an enemy. The trader no longer asks how fast he can make money, but how long he can protect his edge. This shift changes everything. Risk becomes manageable because trades are fewer and more deliberate. Losses, when they occur, are smaller and easier to absorb because they were taken with intention, not impulse. Confidence deepens because it is not tied to constant action. It is tied to trust in process. A patient trader does not feel the need to prove himself to the market. He waits for conditions to prove themselves to him. This waiting sharpens perception. When you are not constantly engaged, you see structure more clearly. You notice when the market is preparing and when it is merely drifting. You stop mistaking movement for opportunity. Patience also protects the mind. Emotional fatigue comes from constant decision-making, not from stillness. Every trade demands attention, judgment, and emotional regulation. When those demands are unnecessary, they deplete mental capital. A trader who treats patience as a position preserves that capital for moments when it truly matters. This is why seasoned operators appear calm while others feel frantic. They are not smarter. They are simply willing to wait. They understand that missing a trade is insignificant compared to entering a bad one. Over time, this discipline compounds. Fewer trades lead to fewer mistakes. Fewer mistakes lead to steadier equity. Steadier equity leads to confidence that does not collapse under pressure. Patience is not passive. It is an active refusal to participate in conditions that do not favor you. That refusal is one of the strongest positions a trader can take. Most losses come from trading against context, not from poor execution. And this is the mistake that quietly destroys otherwise intelligent traders. A man can have perfect timing, a clean entry, and disciplined risk, yet still lose consistently if he is positioned against the broader structure. Context is the environment in which a trade exists. It is the dominant trend, the prevailing pressure, and the larger narrative that governs price behavior. Ignore that environment, and every trade becomes a fight. Many traders believe that if they sharpen their execution enough, they can overcome bad context. This belief is comforting, but it is false. The market does not reward effort, it rewards alignment. When you trade against context, you are relying on exceptions rather than probabilities. You are hoping for the market to bend in your favor instead of placing yourself where it already wants to go. This turns trading into a series of battles rather than a process of cooperation. Against context, even winning trades feel stressful. They require constant monitoring because they are fragile by nature. Every pullback feels threatening, and every pause invites doubt. This emotional strain leads to premature exits, missed targets, and impulsive reversals. Over time, it conditions a trader to distrust his own decisions. He begins to think the problem is his discipline or his psychology, when in reality the problem is structural. When context is respected, the experience changes completely. Trades breathe. Pullbacks feel normal. Time works in your favor instead of against you. You are no longer fighting the market's primary direction, so you do not need perfect timing to survive. Imperfect entries are forgiven because the larger force supports your position. This is why professional operators focus first on context and only then on execution. They understand that execution refines results, but context determines survival. Trading against context also creates overtrading. When direction is unclear or ignored, traders take more trades to compensate for low conviction. Quantity replaces quality. Losses accumulate not because any single trade was disastrous, but because many trades were unnecessary. Context reduces this noise. It narrows focus and limits participation to moments when the odds are clearly defined. It also simplifies decision-making. Instead of analyzing every setup, you evaluate whether the trade aligns with the dominant structure. If it does not, you pass without emotional conflict. This restraint protects both capital and confidence. Over time, traders who respect context develop a calm certainty. They are not guessing which side will win. They are positioning themselves with the side that already has momentum. Losses still occur, but they do not shake belief because belief was never based on a single outcome. It was based on understanding. Trading against context is exhausting because it requires constant justification. Trading with context is sustainable because it requires patience, not persuasion. The market is always telling you where it wants to go. The only real decision is whether you are willing to listen. Consistency is born from simplicity and repetition, not from brilliance or constant innovation, and this truth is uncomfortable for most traders because it strips away ego. Many enter the market believing success belongs to the most intelligent, the most analytical, or the most creative. They search endlessly for better tools, new strategies, or hidden patterns, convinced that the next discovery will finally make results stable. What they fail to see is that inconsistency rarely comes from a lack of ideas. It comes from too many ideas applied without discipline. Simplicity creates space for repetition, and repetition is the only path to consistency. A trader who changes methods frequently never allows probability to work. He resets his learning curve with every adjustment and mistakes motion for progress. The market does not require constant reinvention. It requires correct behavior applied again and again under varying conditions. This is why simple processes outperform complex ones over time. They can be executed under pressure. Complexity collapses when emotion rises. Simplicity survives. Repetition also builds trust both in the method and in oneself. When a trader follows the same process repeatedly, he learns its strengths and its limitations. Losses become familiar instead of frightening. Wins become measured instead of intoxicating. This familiarity stabilizes emotion. Emotion is what disrupts consistency, not market movement. When decisions are simple, emotional interference has fewer entry points. A trader is less likely to second-guess or improvise because there is nothing to improve in the moment. The work was already done before the trade existed. Repetition also removes the need for constant decision-making. Decision fatigue is a hidden cost in trading. Every choice drains mental energy. When a process is simple and repeated, choices become automatic. This preserves mental capital for moments when judgment truly matters. Over time, this creates a rhythm. The trader is no longer reacting to the market. He is responding according to a known framework. This rhythm is what outsiders mistake for talent. In reality, it is discipline applied consistently. Brilliance produces occasional success, but it cannot be repeated on demand. Markets change, emotions fluctuate, and conditions shift. A brilliant idea may work once and fail the next time. A simple process adapts because it is not dependent on perfection. It only requires adherence. This is how equity grows steadily, rather than violently. Large swings in performance are often signs of unstable behavior, not opportunity. Consistency smooths those swings. It reduces the emotional highs and lows that lead to mistakes. Over time, this stability compounds. Small edges applied repeatedly outperform dramatic wins, followed by dramatic losses. Traders who understand this stop chasing excitement. They stop measuring success by single trades and start measuring it by adherence to process. When simplicity and repetition guide behavior, confidence becomes quiet and durable. It does not collapse after a loss because it was never tied to brilliance. It was tied to doing the same correct thing, again and again, regardless of outcome. Survival comes before profit, always, and this is the law that every trader eventually learns, either through discipline or through pain. The market does not reward ambition if ambition is not protected by restraint. A man can be right many times and still be ruined if he allows a single mistake to grow unchecked. This is why survival is the first objective, even before growth. Without survival, profit is meaningless. You cannot compound capital you no longer have, and you cannot think clearly when fear of ruin sits behind every decision. Many traders reverse this priority. They chase profit first and assume survival will take care of itself. It never does. Survival must be designed into every decision long before profit is considered. This means accepting limits. Limits on risk, limits on exposure, limits on how much ego is allowed in a single trade. The market punishes excess more harshly than ignorance. A trader who survives understands that his job is not to win today, but to stay in the game long enough for probabilities to work in his favor. This mindset removes desperation. Desperation is what causes men to oversize positions, ignore stops, and justify behavior they would never tolerate in calmer moments. When survival is the priority, trades are sized so that no single outcome can define the trader's future. Losses become events, not threats. They are absorbed, studied, and left behind without emotional residue. This emotional stability is not accidental. It is the result of positioning oneself so that fear has no leverage. Fear only dominates when the stakes are too high. By keeping G-stakes controlled, the trader keeps his mind free. A free mind is a strategic asset. It allows patience, clarity, and objectivity to function. Profit pursued without this foundation is fragile. It depends on favorable conditions and emotional confidence, both of which disappear under pressure. Survival-focused trading, on the other hand, performs even when conditions are difficult. It may feel slow, but it is resilient. It bends without breaking. This resilience is what allows long-term growth. Over time, small protected gains accumulate into meaningful capital, while reckless attempts at rapid growth often end in collapse. The market offers endless opportunity, but it offers no forgiveness for those who cannot manage risk. Every trader is eventually tested, not by opportunity, but by adversity. Drawdowns, losing streaks, unexpected events, and emotional fatigue are unavoidable. Survival is what determines whether these tests become lessons or endings. Traders who prioritize profit over survival are shocked when adversity arrives. They assumed success would continue indefinitely. Traders who prioritize survival expect adversity and prepare for it. This preparation changes behavior. They do not need to recover losses quickly. They do not need to prove anything to the market. They accept that progress is uneven and that time is their ally if they remain intact. This acceptance removes the urge to gamble. Gambling is not defined by risk alone, but by risk taken without regard for consequence. Survival eliminates gambling because consequence is always considered first. Profit becomes a byproduct of correct behavior rather than a target pursued blindly. This is why seasoned operators appear conservative to outsiders. Their restraint is mistaken for fear, when in reality it is confidence earned through experience. They know that the market will always be there tomorrow, but only if they are. Survival also preserves identity. Many traders lose not just money, but self-respect, because they violate their own rules in pursuit of profit. This internal damage is harder to repair than a drawdown. By prioritizing survival, a trader maintains integrity. He does what he said he would do, regardless of outcome. This builds trust in himself, and self-trust is essential for long-term performance. Without it, every decision becomes second-guessed and every loss becomes personal. Survival-focused trading separates identity from outcome. Losses do not define the trader because the trader never allowed a single outcome to carry that weight. Over time, this creates emotional durability. Emotional durability allows consistency. Consistency allows compounding. And compounding is the only true path to building something lasting in speculation. Profit may be the reward, but survival is the requirement. Those who understand this early build careers. Those who learn it late pay dearly for the lesson.